Perfect. Start recording. Okay. Good morning. Hope you all had a great weekend. Today, the news is a little bit short from last week, to be honest. So I kind of want more so you guys to open up a little bit once I'm done to have some discussion. I kind of want to know you guys' opinion on where your business is at and how you kind of feel it now that Hometown Heroes is pretty much out the window. There are other programs, but I want to know what your pre-approvals are thinking, what your clients are thinking, and kind of even your listings, how your deals are going and stuff. But first off, I hope you had a great weekend. Happy Monday. Last week, there was a symposium at Jackson Hole. It happens every single year. It's basically a gathering of economists, central bankers, and policymakers. And Fed Chairman Jerome Powell did speak there, and he did acknowledge that inflation has come down, but it's not where they believe it should be. And continuing to increase the Fed funds rate is a realistic. Let me do this. There you go. Is a realistic possibility. I can tell you guys, like I mentioned last week, I don't think this month's numbers are going to be promising when they come out, since we're replacing last year's August. And I'm referring to CPI, right? Consumer Price Index. We're replacing last year's August, and that was only at 1.1% month over month. So I don't think it's going to be until we get this month's September numbers, or this year's September numbers, where those numbers become much higher to replace from last year. And that's going to show inflation lowering again, but those won't come out until October. So in my opinion, I think that not only was August tough, I believe that September is going to be tough as well in terms of interest rates. They're probably stay elevated before they start dipping down towards the winter, and then probably opening up towards November, December-ish, I think would be the months that we're going to see interest rates kind of really come down. Maybe not end the year in the fives. I know that I was saying that probably since last year, and I was firm on that till about June, July. It could still be in the mid to low sixes, which would be too far off. But I think there's a lot of different news that's kind of coming out. And if the Fed hasn't stopped raising their rates like we thought they would, that's really going to be an issue for the market and the liquidity that's in it over the next few months. So we're hoping that October kind of shows inflation really is coming down at a steep rate, because those numbers on CPI are going to be 0.4%. So it's going to be very tough to kind of combat that with this year's numbers. On average, every single month in terms of our CPI ratings, we've been at like 0.2, 0.3 consistently throughout the year. So to be at to kind of overcome that 0.4 is going to show a negative, right? But when we're looking at last year's 0.1%, if we show 0.2, it's going to technically show that inflation has gone up 0.1% year over year, right? And so it just really depends on that rolling 12 months and kind of what that looks like. But I believe because of last year's numbers, how bad they were towards the end of the year, is actually going to be better for us at the end of this year, because we're going to be replacing those numbers and showing inflation kind of decreasing towards the end of the year. Existing home sales fell 2.2% from June to July, and they're 16.6% lower year over year. Existing home sales are owners who are selling their homes, right? So existing structures, those numbers are going to be low, obviously, as rates increase, because it doesn't make financial sense for homeowners to sell their homes unless they absolutely need to. They're going through a hardship, they're relocating, whatever the case is. A lot of people right now that can purchase their home or can sell their homes are not. And if they're asking me, I'm telling them not to. To be honest with you, it doesn't make any sense for them to. So it really just depends. But new home sales, however, did really well in July, and it showed an increase of 4.4% month over month and 31.5% year over year. And that's with the National Association of Home Builders showing their home price index. We look at it every single month. Last week we saw it was at 50, but before that in July or June, it was at 54. It was above 50, and it has been above 50. So they have been continuing to build. So those numbers are going to continue to show as we look at the month over month and year over year. I won't be surprised if towards the end of the year we see the month over month numbers lower, because that home price index actually decreased for the first time last month. We saw it last week. They went from 54 to 50. And if it decreases again next month when they do their confidence level, that means that signals contraction, right? That home price index measures from 0 to 100. Anything above 50 means that they're looking to expand, which they have been for most part of the year. Anything below 50 means they're looking to contract. And right now they're at that 50 mark. Mortgage applications have continued to come down, and they're at the lowest level that they've been since 1995. Mortgage applications are down 30% from this time last year. And that's when mortgage applications are basically, they come out every single week, and that's people that apply for a mortgage. So this is usually a good reading of where the market is or where it's going to be. And I do firmly believe that these next 4 months of the year are going to be ice cold for a lot of people. So make sure that you are focusing on your sales activities. I can't express it enough, following up with the people you're supposed to be following up with, as I think that this last quarter in general, from October to December, even though rates are going to soften up a little bit, it's going to be a little bit tough for a lot of people. All in all, looks like rates ended in a positive last week, which is good. And they're starting today pretty good as well. But we need to see where PCE lands, which is personal consumption expenditure. It's what the Fed's favorite measure of inflation really is. That comes out Thursday this week on the 31st. And this is really going to dictate if we see rates continue to move higher or actually decrease a bit before that CPI report in September. And lastly, I want to talk about Zillow. You guys probably saw over the weekend, Zillow came out with a 1% down payment option within their mortgage department. But of course, once again, it's just a marketing tactic because the person does need to be at 80% area median income or below, which we know in this market means they cannot necessarily afford anything. 80% area median income in Miami-Dade and Broward County is about $60,000 this year. So you can imagine. You can imagine that in other counties where the income is probably not as great as they are in the tri-county areas. So it makes it very difficult for somebody to be able to approve for this, but you hear 1% down payment, you kind of gravitate towards it. It's offered as a grant from what I read, which means it is forgivable after closing, but I can imagine the rates on that are going to be higher than what the typical market rate is to be able to subsidize the cost of that 2% that they're giving. There's nothing that really states that those rates are going to be higher, but I understand mortgage banking. I know that when money is given up on one side, it's usually made up on the other, typically is how it works, unless you're doing these third-party type of deals, like with Hometown Heroes specifically, where they had their own specific rate and they gave the down payment assistance. That's a little bit different. But usually if a lender or a bank is doing these loans, it's usually because they're raising their costs on the back end through higher interest rates, charging more points at closing, whatever the case is, to make up that extra money on the front end. So it's going to be interesting. I know that Zillow's trying to capture market share a little bit, and so they're pulling out this program to kind of do just that and have people apply and tell them that they don't qualify, but hey, you can still do this or you can still do that. It's typically what it is. I know I had somebody ask me last week if there is any sort of 100% financing that's not VA. If any lender tells you or anybody, a client comes to you and say, hey, this person's offering 100% FHA financing, this person's offering 100% conventional financing. Guys, there is no such thing. Okay, if you look at specific FHA guidelines, you look at specific conventional guidelines, which what I tell everybody is every lender and bank has to play by a base set of rules. Those are the national guidelines given directly by the GSEs, right? FHFA has their guidelines for Fannie Mae and Freddie Mac, and HUD has their guidelines for FHA, and it states that those loan to values, the maximum on conventional is 97%, the maximum on FHA is 96.5%. Okay, the way that you're going to get to that 100% is the combined loan to value, meaning that if somebody's saying I can do FHA at 100%, it means that there's a second mortgage that's attached to that that's going to push that to 100% financing. And it's very similar to that Hometown Heroes, right? Where we didn't say, hey, Hometown Heroes gives you 101% financing or 102% financing, even though that's technically true. It's just the way that you sell it, right? Or the way that you market it as a lender or as a loan officer or whatever the case is. Bank of America did this last year, where they said we're doing 100% financing up to $10,000. That means that you're only going to get 100% financing if you're at $300,000 or below, right? Because 3% of 300,000 or 3.5% of 300,000 is around that $10,000 range, right? If you're at 400, you're not going to get 100% financing. It's the way that you word it. I could do the same thing with the Florida bond. I do 100% financing on FHA and conventional up to $10,000, right? So if you have lenders that are telling you that, loan officers that are telling you that, ask them, how much is it that, what is the maximum that the client's going to get in terms of the down payment assistance? Is it going to cover the full amount? Is it a second mortgage? If on that second mortgage specifically, do they have to make payments on it? Because a lot of people right now are pushing Chenoa Fund, which will give you 100% financing no matter what that purchase price is, 300, 350, 400, 450, because it's based off of that percentage, 3.5% or 5%. The difference with Chenoa Fund is that you have to make payments on that monthly. Okay, it's not completely forgivable. And if you borrow $15,000, when I've done the math before, you end up paying back like almost 150% of that. So $22,000, $23,000 once you're done making those payments on that loan. And Chenoa does have a forgivable option attached to it, but then it won't give you that 3.5% or 5%. You may end up with 1.5%, 2%, right? It goes back to what I said when I first started this conversation about Zillow, right? Wherever they're giving you money, they're usually taking it somewhere else, right? And so just kind of think of that when these loan officers or these lenders are trying to tell you these financing programs that they have, right? Ask them those questions. Is there any repayments that have to be made on that second mortgage? You know, what are the qualifications? How does it work? Because a lot of it is just marketing. That's all it is. Do you guys have any questions, any sort of scenarios you've been going with? You know, any tips that you can give us on how you're succeeding in this market? Anything?
I have a question. So how does this that 100% financing with the condo, like a piggyback loan, work?
Mm-hmm.
The condo usually require like 25% down. Like, how does that reduce the buyer's obligation? Or
that's a great question. So there's two versions of condo financing. There's a full review and a limited review. On the limited review, typically that means that they don't have a budget. And if they don't have a budget, then you typically have to come in with that 25% down on the first option. Now, if that client does end up getting a second loan, they can get financing up to 90%. That's the maximum, right? And so, and this is very important because I've had this issue, or not this issue, but I've had to explain this a lot of times where we're using city and county down payment assistance funds on lower price condos, which typically are the ones that don't have a budget, right? And so the agent asked, why can't we do 100% financing? Well, because conventional guidelines say that if we're getting a second mortgage, which technically these down payment assistance programs are second mortgages, they may be forgivable in the future, but the way that they start is as a second mortgage, which means that that client will only be able to get the funding of that down payment assistance program, whatever it is, up to 90%. So they still have to come out of pocket. If there is no reserves, 10% down plus closing costs. That down payment assistance program is only helping them cover that 25, technically the 75% loan to value, right? Up to 90% loan to value. So it's covering the difference of that 15% that they would technically need without that second mortgage, but they're still responsible for 10% down in closing costs if the budget is not intact, because that's what conventional guidelines require. The maximum combined loan to value is 90%. Okay. If you're doing a full review or that condo is approved directly through Fannie Mae, which we have the list, then yes, you can do up to 105% is the combined loan to value, the maximum. So at that point, you are able to get 100% financing, but that budget is very important to know if you can do it that way or not.
Would you be able to would they get that second mortgage from you, or they have to go find another lender for that?
No, so we can do the second mortgage if we're doing it, if they qualify for the city or the county because they're lower income, then we would do that.
In our case, she wasn't. She was kicked out of that because her name was on family property. Gotcha. And she lives in it. So.
Yeah, so the other option is doing basically a HELOC at closing is what it is. It's a line of credit. where they cover up to that 90%. So they'll do the 15% down. Their minimum loan amount is like $50,000. And there's a payment on that second mortgage usually. But when you consider, right, if you were to do 5% down on conventional, what that payment looks like compared to what this other one would do with giving you the difference in that down payment, and you don't have mortgage insurance or anything like that. Usually the payment difference is about $100, $150 is not too much. But you do make payments on that second mortgage if it's a HELOC.
Now you said a HELOC, which property would we be taking those funds from? The property that
It would
they're
be on the
purchasing?
purchase. Yeah, it would be on the purchase. So they're basically opening up a HELOC at closing, and that HELOC is going to cover that up to 90% for them. And they would only have to come in with 10% and closing costs.
So they would have to purchase a property with equity in it.
Well, you would come in technically with 25% down, right? The difference is the HELOC is covering the difference.
Okay. Very technical, but okay, thanks.
Yeah, that's the technical part. I mean, I could just tell you that we could do it at 10%, but that's kind of the way that it works. It's just going to be a HELOC that's attached to it. And the payments right now, because it is based off the US prime rate, is probably going to be like $350, $400 a month. But it's shaved from what it would look like if you were to do a regular conventional loan at 5% down, because you have mortgage insurance, you're paying more for your principal and interest at that point, stuff like that.
Okay, thank you.
No problem.
Mike, hi, this is
Hey, Yolanda.
Yolanda. Any tips on keeping our pre-approvals engaged?
Yeah, it depends on what's holding them back. I mean, we're following up with a lot of pre-approvals, and we're hearing inventory is one issue. And then we're also hearing, to be honest with you guys here, the realtors are just sending the emails in terms of what the properties are, and they're not following up with the client specifically. Did you see this property? Did you do this? It happens a lot in the beginning when that client is hot, but as that client starts to kind of fall out or become less responsive, the realtor starts to follow up less and less. My tip is, if you have a pre-approval, even if it's warm, even if it's cold, continuously follow up with them within your CRM, see how they're doing, see if they got the new listing that you sent over to them, even if it's just a conversation. Hey, this one just came on the market within your price range. You sure you don't want to go take a look? No, rates are really, really high, unaffordable. Okay, let's reach out to the loan officer, Mike and his team, this guy and his team, or whatever the case is, and let's run the numbers for you ahead of time before we go look at it to see if it makes sense and have a conversation. And at that point, now you're keeping them engaged and you're trying to solve their problems for them. I think it's more so making sure that you're consistently following up is the key. Because as we do our follow-up,
I'm sorry. Yeah, I got that part. I meant in terms of, since the Hometown Heroes, they were, of course, pre-approved, for that program. But since it's gone away and there are no other options like the Genoa Fund, they won't qualify for that. The MD, they don't qualify for that. So I meant in that aspect, as far as keeping them, engaged, since, okay, Hometown Heroes has gone bye-bye. What do we do now?
Yeah, so if they were pre-approved Hometown Heroes, you need to see if they could get switched over to Florida Bond. Florida Bond is very similar to Hometown Heroes. It has a little bit extra requirements, but it gives them $10,000 towards their down payment. It's not as much, but it does still close the gap. And I think now, especially getting into the last 4 months, the market's going to be a little bit slower. So now you're going to be able to get those seller credits as well, that you may have not been able to get these last couple months because everybody was utilizing Hometown Heroes at the time. So it's just switching them over to that Florida Bond if they qualify, and then attacking the seller with an extra, usually $5,000, $6,000 will pretty much end up being the same thing of what Hometown Heroes would give them. So they do have an option in Florida Bond. The income limit for Broward, I think, is 105,000, 110,000 or something like that, within the household specifically. So that's the kind of the difference between Hometown Heroes and Florida Bond, is it is going to consider the household income. So even if only one person is on the application, husband or wife, if they're married, we still have to consider the other husband or wife's income, unfortunately. So that would be the tough part. The good thing is about the Florida Bond, though, is if you get a co-signer, we do not have to consider that person's income like we would with Hometown Heroes. So if that person has a sister that makes $200,000 a year and they only make 80, that sister is going to help them qualify for something that they want, but also not affect their down payment assistance because that person is not technically living in the property. So there's pros and cons that come with the Florida bond, but that's a good avenue to kind of shift gears towards it because it still has a higher income limit to it, and it still provides down payment assistance as well as the client not worrying about having to pay points, as well as it reduces the real estate taxes that they pay at closing as well. So there's still a lot of benefits that come with Florida bond, and Florida bond doesn't run out of money.
Mike, I have two questions, both pertaining to the bond, the Florida bond and the piggyback loan. Is there what is the credit score minimum requirement for both of those?
So for the Florida bond is still the 640, very similar to, because it's the same people, it's Florida Housing, it's the same people that do Hometown Heroes. So that credit score minimum is 640. They have to be still considered first-time home buyers. And the difference is that we need to get their tax returns. So those are going to be the three big differences that come to Hometown Heroes. That income limit, like I mentioned, I think it's about 105, 110 around there. And then for the second mortgage, if that person is doing a condo without a budget or without reserves, typically the minimum FICO is 680 on those HELOCs.
Thank you.
No problem. And Deborah, to answer your question, if their pre-approval is still active, I just need to see if based off of their specs, they qualify for the bond or not. So it would just be a quick yes or no, as long as their pre-approval is active. They don't have to go through the whole process again. No problem.
Good morning.
Good morning.
So I have a question. I have an investor that they tried to get a pre-approval with a credit union, and they wanted, really, it's not a pre-approval, excuse me. They wanted to pull money like a HELOC or a refi from their rental property. But they stopped them. The mortgage company said no, because that rental property insurance lapse, property insurance lapse. Is that a thing? Is there something that Highlands will be able to avoid, or is there any fix to that?
So what do you mean? Like they were without insurance for a period of time?
Yes, so they have the property insurance. They had a leak or something going on, and their property insurance wanted them to do something, and they didn't do it, and they canceled it. So they wasn't aware, or they dropped the ball that the property insurance lapsed. And then when they tried to go in and try to do something with that property to take out money because they want to buy another property with the equity, the mortgage company that they was dealing with said no because of the insurance.
Yeah, I mean, as long as they come to us with insurance, we're not going to ask for the previous insurance policy, right? So if they come and that insurance has been active since July, we're still going to use that insurance policy, and we're not going to ask what happened in the past or anything like that. So yeah. Now, if they went to that other company and they weren't insured at the time, that's probably where the issue came in for them.
Okay,
but
I got it.
Yeah, as long as they're insured, we should be fine.
Yeah, as long as they have a current insurance when they apply, then we're good. Got it.
Yeah.
Thank you.
No problem. Any other questions, scenarios? No?
Yeah, I got one, Mike.
Go ahead, Carl.
Okay, with the Florida bond, can you tell me what the not the credit score, but what is the annual for that? Do they have to make for that?
Yeah. I'll pull it up for everybody here. That way I'm not guessing. I'll give you guys the actual number here. Okay, here we are. Share screen. Okay. So for Broward, 1 to 2 person household is at 101. 116 is the max. So actually I was below. And that's for 3-person household, 3+. So if it's 2 of them and they have a child, they'd qualify under this one. Don't worry about targeted. Like I mentioned to you guys before, targeted is very, very small pockets in all these counties. And then there are purchase price limits, but they're relatively high, right? 568, 557 is what you're going to be looking at in terms of those acquisition costs, and that's specifically in Broward. If we were to do Miami-Dade and Palm Beach, Miami-Dade's 1 to 2 persons, 103, 200, 3+ is 118, 680, and then purchase price limits the same. And Palm Beach County, 101, 267, 116, 458, and then purchase price acquisition is the same. So just think no more than $115,000 between whoever's going to be on the application, unless there's a cosigner involved, then you don't have to worry about the cosigner's income. But whoever's going to be, I guess, staying in the property for the most part, we have to make sure that their income is below that 115.
Okay. So the minimum is what? What's the minimum that they need to make annually before they can qualify?
No, there is no minimum. There's only a maximum.
Lima child.
Yeah. So they'll be fine no matter what they make, as long as they're below that 115 for a 3-person household or below that 100 for the 1 and 2, they'll be fine. And this is the stuff where you guys have people that are currently pre-approved hometown heroes, that loan officer, because it's directly e-housing, should also be able to offer the bond program as well. So talk to them about that and see if that client will fit within the bond program. Because Hometown Heroes and Florida Bond are from the exact same people, Florida Housing. Same thing with us. If you guys have pre-approvals with us specifically, then we're Hometown Heroes. Like I mentioned last week, send me an email with the names of the people so I can look into them and let you know if I can green light the bond for them, so that way they're not discouraged now that the Hometown Heroes funds have run out. Okay. That's it. It is 10:31. Hope you guys all have a great week. Next week is Labor Day weekend. I'll probably be in the office, but we probably won't have Monday Mortgage Minute because I know a lot of you guys may be on vacation, maybe at the beach that day. So if not, I'll see you guys in 2 weeks and we'll talk then.
Thank you,
Thanks,
Mike.
Mike.
No problem. Thank you all. Have a good-